Hey guys. So today I want to look at the idea of income versus cash and profit versus cash. Uh, so we're going to start this by looking at income statements and how they kind of function and what goes into them, including some really key definitions, including our revenue and expense definitions. Because at the end of the day, what we're looking at is an area where sometimes things will overlap. And to this point, you've looked at cash and cash inflows and cash outflows, but not all of these inflows and outflows are going to be fitting the definition of revenue or expenses. So we need to be able to discern these sorts of things. And this will be the first chapter where we start to look at the idea of credit, which is going to be something that we delve deeper into in the next chapter. So let's take a look at the slideshow and jump right in. So today we're focusing primarily on income statements for service firms, but you need to understand that this will also at times apply to trading firms. So first off, when we're looking at income statements, it's important that we distinguish between the statement of receipts and payments and our income statement. So the statement of receipts and payments just looks at every cash inflow and outflow that occurs within the business, whereas the income statement focuses on the definition of profit underneath the accrual assumption. And if you remember the accrual assumption, it's that the revenues that occur within the period are matched against the expenses incurred, which gives us this definition. Okay, profit equals revenue earned less expenses incurred. Now, you might be asking, what is revenue earned? So, revenue earned isn't just the cash that flows in, but it's actually all revenues that flow into the business during a period. So, this could be credit transactions that occur during the period. And we need to make sure that we understand that revenue can be recognized as earned if goods or services have been provided. We don't necessarily need to have cash flow into the business. What we have instead is we've got the service provided and a source document that confirms the amount that's being charged. The second part of that is the expenses that we incur. Now, a business may have expenses in a given reporting period, and these could be a lot of different cash items, but it's not simply the expenses that we paid in cash. Again, in order to accurately determine our profit, what we need to do is we need to identify all the expenses that occur within a reporting period, which may be some things that we haven't paid yet. So when we're looking at our income statement, it's important to note that it will include every single piece of revenue earned and every single expense that's incurred, even if we haven't paid it. Now, the key part of that is cash versus profit. It's important that we keep in mind that there is a difference between cash flows and income statements. So let's look at the following example. If we think of cash flows being cash that we receive from clients, cash contributed by the owner, loans from banks, things like that. So sales to clients, yep, that's definitely a revenue. But it also includes the credit transactions. They're not included in cash flows. Now, capital contributions, they're inflows of assets that do increase owner's equity, but they're specifically listed as not revenues. And loans do increase our assets, only increase our liabilities, not our owner's equity. So it's, again, excluded. So you're starting to see that whilst there is some overlap, there are some key differences. Same thing with our outflows. We might pay cash to our suppliers. We might pay wages. We might withdraw cash as the owner, or we might make loan repayments. Now, for the income statement, we actually only list the goods and services we use. And we also have to consider the things that we pay for on credit. Our drawings, not expenses, specifically not listed even though they fit the technical definition of an expense. And finally, our loan repayments aren't expenses either. Now, when it comes to net profit in the balance sheet, it appears in the owner's equity section. This is because it is the net profit that goes to the owner. It's theirs. So this will either increase or decrease our owner's equity. Here's an example. So we can see we've got $100,000 of capital and we've earned $20,000 of profit, which means that our owner's equity becomes $120,000. We then remove our drawings, which gives us our final balance of $110,000. Now, it might be in some cases that we actually don't earn a profit, but we instead make a loss. And that would be shown simply as withdrawing from owner's equity. So now let's wrap it up. So what you've looked at today is pretty in-depth, and I've only just given you a quick glance at some examples of how cash versus profit can differ. Now, the one thing that you really need to do is you need to make sure that you've got a really clear understanding of your definition of revenue and your definition of expenses, and some examples of how that might sometimes overlap with cash, sometimes might be different. If you can understand that, then you are well set up to understand every single thing that we cover for the rest of accounting. So I'll leave you guys with the questions that you need to do, but if you do have any questions, feel free to get in touch with me and I'll help you out, but I'm sure that you'll do just fine. Thanks and see you.